Hello and welcome to Switzer Investing TV. I'm Peter Switzer. Thanks for joining us. On today's program, I've got Mike Gable from Fairmont Equities. He's our charts guy. He's going to look at a number of really important stocks that people are interested in. Of course, he does look at the indexes, the Australian market as well as the US market. We're looking at Neuron Pharmaceuticals, Ordinate, Megaport, LYNAS, the CBA. Do you really believe it's going to fall by 43%? That's what Citi's analysts are saying. RIO, NextDC, 0, and he has his own mystery pick. We have to wait to see what that one is. And then Paul Rickard's back from overseas. I'll ask him about some pretty important matters like Trump tariffs, how it's going to affect the market this year. The CBA, does he think it's going to fall? I know he's been negative on the bank, even though he's a big holder of CBA shares. And we'll look at what he thinks is the best company to chase this year for growth and the best dividend play for this year as well. So without any further ado, let's cross to Mike Gable of Fairmont Equities. Thanks for joining us, Mike.
Thanks, Peter.
So, tricky times, Trump tariffs and a little bit of inflation fears creeping into the market.
Yeah.
You always start off with the S&P 500 index. What's it telling you?
Yeah, look, despite all the fear or concern about what Trump might do, the market's still trending higher, and it does look like it can continue to head higher. So, looking at the S&P 500 chart, this is going back almost a year now. As I said, still trending. What's interesting in terms of the most recent price action since, say, mid to late January is, it's good to see that the market is still hanging in there. So we started the year with a bit of a sort of end of December, early January with a bit of a pullback. It rallied quite strongly in mid-Jan, and now we could see it sort of consolidating near those old highs. So, that's a positive sign. So far, it's telling us that the selling pressure isn't enough to bring the market all the way down. And at the moment, it does look like it's just using up a bit of time before it's ready to move higher again.
For people at home watching this, do the colours mean anything?
Yeah, they do. So on my charts, I've put red to represent. So this is a daily chart, meaning each candle is 1 day. So red means that the market the market closed at a lower point than where it opened.
Okay.
And the black means that it ended up closing higher than where it opened.
So if you looked at that, the collection of blacks outnumber the collection of whites. They're significant, similar in terms of the movements, in terms of the length of the candle. So therefore, it's a positive sign, even just looking at the colours.
Yeah, 100%. So, a lot of big red candles is a negative.
Yeah.
But yeah, as you mentioned, as we could see in this period here, we have more black candles than red. So the market tends to close strongly at the end of the day compared to where it started. And that's a positive sign.
And because you've done this a long time, there's a kind of muscle memory in there, whatever that is. Young people tell me that's how they do all their digital stuff. But you must look at it and just have an instant gut feeling about, gee, this is looking okay, or gee, this is a bit of a worry.
Yeah, in a split second, I can tell if it's worth looking into further or not. Yeah.
And you're not worried now?
No warning signs. Look, ask me in a week's time. Things might have changed, but at this very moment in time, it's looking good.
We expect if you do change your mind in a week's time, at least ring me.
Pass it give you a heads up.
Our viewers. Let's go to the ASX now.
So the ASX, so this is now a weekly chart, going back the past few years.
This even looks better.
Yeah, it's the same chart I've been bringing in for a while. It's still, our market's still trending ever since the start of last year when we identified that major breakout above this line, and we're trending. So again, at this point in time, no warning signs for our market. Still looks like it wants to head higher.
Rate cuts, do you think that will reinforce it, or do you think the market's already building that in?
Look, it's built in, but if we don't get a rate cut next week, I mean, the market's been disappointed before. It just gives you a bit of short-term volatility. But, I think that, ultimately we are going to get these cuts throughout the year, and that's a positive for markets.
Yeah, without a doubt. Let's go to the first stock I've asked you to have a look at. Now, this is called Neuron Pharmaceuticals, and as we can see, it's had some great days, and even in the low days, I've had some great days. That big spike, and all of a sudden it comes off. What do you think's going on with this company?
Look, it's not one I follow, but but clearly the price action is a bit crazy. So you need to maybe be a little bit crazy to be able to stomach this sort of volatility. So this is a daily chart going back over a year. We could see that end of 2023 there was the huge rally, but it's given up all of those gains. And the first
someone made money, and someone's been taking profit.
That's right. Well, exactly, and you've hit the nail on the head. Taking profit. So the first thing that jumps out at me when I see this chart is every time this rallies, people are getting out or taking profits, and that's because we could see these big spikes every time it rallies hard. Just gets sold off straight away. We've seen that on numerous occasions. Mid-January, another big spike up. Are we going to see the same thing? So far, it is struggling. So I think it's too early for me to start to feel confident there's a low there, because there is a lot of selling anytime it rallies. So there must have been obviously quite a few investors have bought up at those levels, and even at this point, you can imagine that after this bounce here and this rally, you might have had investors getting in thinking, okay, this is the lows, and now they're starting to get back to break even, and they'll be hitting the sell button. So at the moment, it looks like this will be under a bit of pressure for a while yet.
It's at this point in time, it's definitely a punter's stock to gamble. At this point in time, you're not seeing anything that make you think, this might be worth having a crack. Because if we got down around $11, I guess it'd be a very low price in relation to this company. But you have to know what's going on with the company. And of course, Trump's talking about pharmaceutical tariffs as well. But interesting company. Let's go to the next one, mate. This is Ordinate, AD8. Another one that was a darling of the market, has been copping it. Do you think they're building a base around $7.80?
Still early days. So, classic example of a stock that, once it goes parabolic, it often ends, usually always the same way, which is falling all the way back. And this is almost a mirror image of that side of the chart. Unfortunately, the mirror image sort of theory will probably continue on with this, meaning that, it'll end up at best moving sideways a while, like what we saw here. So still very much early days. It's still, still drifting lower. Great example why you need to run a trailing stop. I think we looked at this one at one point in time and suggested even if it was a 20-day moving average or just something like that, just to help you get out of the trade when it turns. But too early, I think, to be getting into this one. It might just be trading sideways.
Consensus view on AD8 is 33% upside. But it's a tech company, and I think it's a good quality tech company, but it's got a few challenges at the moment. Another similar business, I think, is Megaport, MP1. But are you seeing, looks like the base is looking a little bit more promising.
For the moment, it looks like it's starting to see some good buying support. So what I've noticed is, just in this little section here, this is a weekly chart. What you've got is a period where it's been heading low with the lower highs. And what it's now done is it's cracked above this previous high point, which is a good sign. So, if the sellers were still in control, once it got near this high, near this blue line, you would have seen all the selling come in and it would have started to turn lower, but it's managed to breach that. So for at least for the short term, I think that this can head higher, but it might be hard going, as we could see just over the past few years. The majority of the trading days, anyone who's bought would still be underwater. So what that means is once it, if it does continue to head higher up to sort of 10, 11, 12, there'll be a lot of people that bought around these levels and they'd be looking to sell. So Yeah, it'd be a hard slog, but at the moment it looks like it's trying to improve.
Both AD8 and Megaport, a lot of the people who I've interviewed say they're expecting both companies to improve down the track, but the next few quarters could be challenging. Let's go to LYNAS now, LYC. There's been some positive news around, Australia supplying rare earths, competing with China. And it's had a few spikes. What's happening now?
Yeah, so this is a weekly chart going back a few years. It does look like we've seen the low in this. It's still, pretty volatile, like the past few months. Big rally with a big sell-off, but it does look like this downtrend is over. It did break that downtrend mid last year. It has eased back to sort of where that breakout zone is, but very positive price action last week. So this being a weekly chart, each of these candles represents 1 week's worth of trading. So if we have a look at this large black candle here, what it's telling us is it started the week down here, but by the end of the week, it closed all the way up there, which is quite a significant move. It looks like, from it looks like at least a 10% move in the space of a week. So strong price action. Yeah, very volatile, but I'd say over the next few months or so, this should be heading high.
Yeah, probably one to watch, given the fact that it's had some pretty high prices in the past, but also it's a tricky company because it actually is in Malaysia, isn't it, LYNAS, and an Australian-owned company in Malaysia. Let's go to CBA now, and I should just throw in advance that the analysts think there'll be a 35.8% fall. City sees a 43% fall. Are you seeing it in the charts right now?
No, I mean, this time last year we were seeing the opposite in the charts because there was a major resistance level at $110. And once it broke above that, that CBA was always going to rally just as the market was breaking out. It's the biggest stock in the market. If the market's going to rally, CBA will go up as well. So, if they think CBA is going to fall 30%, then they must have, very, very low downside targets for the broader market. So it just doesn't make sense that the market and the CBA will diverge in a massive way. So big breakout start of last year at $110. Look, I didn't expect it to be at 160 in that period of time, but the charts were looking good last year, telling you to stick with the banks. Now, unfortunately, these fund managers are going to lose their mind again because CBA, I think, will continue to push on and on from here, and they won't understand it. But that's what the chart.
It'll no longer be a great income yield stock, but it'd be a great capital growth stock.
Yeah, that's right. And the reason why I think it'll push higher is, after this sort of initial peak here at the end of last year, it did come back, but it did come back a little bit in terms of the selling pressure, but straight away it bounced back up, and we can see that any selling has been met with buying. So you have this period here over several weeks or so where it's essentially traded sideways and spent most of this period up here near 160 as opposed to down near 150. So that's showing a lot of buying pressure. And we could see in the past few days it has started to crack out of this range. And when I look at other banks like Westpac, it's displaying similar characteristics in that it looks like it's going to break higher and rally. So, CBA, to me, it looks like in the next few weeks or so, it could be 170, and everyone won't understand it, but that's what's happening.
It's a bit like Homer Simpson's view on donuts. Is there nothing CBA can't do? All right, let's go to RIO now. Clearly having some challenges with Trump tariff talks of aluminium and things like that. What are you seeing there?
Yeah, look, seemingly a bit of a messy chart. I mean, this is only going back a bit over 12 months. If I look at a longer term chart of RIO, I think that at least for the past few years, it's been trading sideways, but the volatility, even though it looks quite large here, it has generally been, the trading range has been getting tighter and tighter. In terms of the short term, we had that big bounce in September. And then obviously since then, it's given back a lot of those gains. But to me, it does look like it's, the trading ranges are starting to tighten up. We might not get anything spectacular soon, but it does look like the ranges are tightening up, and that means it should be then getting ready to make another run up towards that sort of high 130s region.
Yeah,
so
the black candles are bigger than the pink ones.
yeah, it gaps a lot, but yeah, I think that to me this looks like it's just using up a bit more time, and then it'll be ready to go again. Possibly the catalyst could be a big drop in the US dollar, because we know that the US dollar's had a massive run after the election.
Yep. RIO analysts about a 7% consensus rise. Company, a great company, NextDC, potentially challenged some thought because of DeepSeek and AI. I think that's been a great exaggeration. But and the analysts think there's about a 30.5% potential rise. Do you think that rise anytime soon?
I think this is looking a bit weak. I mean, very messy price action for most of last year. To me, it does look like it was possibly topping out, and it started to break down at the end of last year. It tried to rally the start of January, but it's fallen again. I mean, obviously because of DeepSeek. I think all that DeepSeek stuff's an exaggeration. If anything, it'll
add to it.
It'll add to it. So I mean, I'd be happy to buy a Goodman Group here as an example. That was sold off unnecessarily, but this one, yeah, I just don't like the way it's trading. To me, as I said, it just looks like it's rolling over, and it might need to just come to cheaper levels before
It did do a placement last year, didn't it? At NextDC.
I'm not a holder of it.
Yeah, it did. So and I guess that wasn't a great help to.
Might be a bit of pressure there.
Escalating the share price. There's obviously more shares on sale.
Yeah.
Let's go to Zero now, which continues a bit like the CBA version of tech, isn't it, the way it's been going?
Yeah, it looks great. Obviously, it's trending in terms of recent price action. Obviously, ran a bit too hard here, so it sold off and needed to. Yeah, when a stock rallies really hard like
no
that.
pink candles at all in that little section.
Yeah, just all strong closes for several days in a row. But when you get a very strong move like that, of course you'll get a bit of selling, and either the share price retraces quite a bit due to the selling, or you start to get a bit of selling, but you get a lot of other buyers step in who missed out on this move. And that looks like what we have in Zero. So you had the initial sell-off, but it started to level out here across late December, early January, which does indicate that those that missed this rally have figured, okay, well, 165-ish is that's good enough for me.
Yeah.
And now whoever was trying to take profits is gone, because it's been released, and it's rallying again. So I think it looks good.
Yeah, it's got a pattern of rises, consolidation, and rises, hasn't it?
Yeah, that's what you want to see in an uptrend.
Yeah, without a doubt. Let's go to your pick. Is it CDA or CBA?
CDA.
Yeah.
So when you're done buying CBA, buy CDA.
Yeah, coded.
If you fat finger it, this one will still go up.
Okay.
And if you get the wrong one.
Right.
So yeah, Codan, they manufacture a lot of communications equipment. They've got a history manufacturing metal detectors, but
so there's people on the beach who have Codan products.
Yeah, they probably are. They probably are, but a lot of communications equipment for possibly even the Super Bowl today. I don't know if they use Codan equipment, but they do supply a lot of equipment to stadiums as well as military organisations overseas. So, but what I really like about this chart is the way that with the uptrend, you have the powerful moves higher, and then it does consolidate, followed by another powerful move. So what we've got is start of last year, big move, and then we had this sort of sideways consolidation, another powerful move, and then we could see since sort of late August, sideways consolidation, and now it's breaking out of that. So if we get follow through here, you should end up with a fairly chunky move. Because the general rule is the longer a stock consolidates, the bigger the move when it does eventually break out. Yeah, and that's a great example. So history might repeat with this one, and yeah, it looks like it's right in the buy zone now.
Okay. Are you anticipating, if the RBA cuts on Wednesday next week, or Tuesday next week, that that will be a plus for the market generally?
Yeah, I think the market will have a bit of a kick on. I mean, we're still dominated by what happens overseas, so I guess the timing of anything that Trump might say could affect us. But hopefully, investors eventually, learn the lessons from the last time he was president and realizes that what he says today isn't necessarily what he's going to follow through with.
So buy on his comments that spook the market, you're indicating.
Yeah, I think so. I mean, he's clearly creating a lot of volatility. But I think this year will be another good year for markets. So, like the DeepSeek example, I mean, that wasn't as a result of anything he said, but I think any sort of negative volatility, negative movements that we experienced this year, just use it to step in and buy what you like.
Well, certainly the market index is screaming that you should be a buyer, not a seller.
Yeah, exactly.
Great stuff. That's Mike Gable of Fairmont Equities. Well, joining us now is Paul Rickard, back from overseas. Clearly, the movements of the market didn't disturb his holiday. How are you, Paul?
Very well, thank you, Peter.
So you've had a chance to sort of both relax on your holiday and undoubtedly read a lot of stuff that's going on in the USA with Donald Trump. The tariffs, are they going to bother you in the way you're going to invest this year?
Look, I don't think so, Pete. I think people and the market is sort of, working on the basis he'll use them. I think in a selective basis, longer term, and while there might be some short-term announcements like the one over the weekend about the 25% on more steel and aluminium imports into the US, there'll probably be exemptions from that in the media for some countries, and so I don't think the market's too worried about it. But I guess they're probably got a long way ahead of themselves, and I think the sort of it may just, in some ways, just give them a bit of a reason to just pause a little bit, Pete, because we had a very strong rally in the US. We've sort of kept largely a pace of it in Australia, haven't had the same performance, but the markets have got a lot built in this. Earnings season is over. They're not going to get an interest rate cut for a while. Maybe the data they saw on the weekend with the unemployment number and also the wages growth might just to give a bit of cause for concern that inflation is sort of still there a little bit. And I just wonder whether we're due for just a bit more of a sort of a wait and see from the US market. And I think that'll flow through to Australia. So I don't think it's tariffs that's going to be the big issue, but that's certainly what's grabbing the attention at the moment.
Yeah. It's like at one stage I wrote that the Goldilocks recovery being, not too hot, not too cold, just right, seemed to have been overtaken by a Trumpalocks recovery where it's excessive, wasn't it? Excessive confidence around deregulation, lower taxes, and even at one stage, the tariffs don't seem to be as serious as we thought. But I guess what he's doing is just putting good reason to be cautious, and that's going to take a bit of froth out of the market.
Yeah, that's my sense. I think a lot of the good news has happened, and now the market's got to see the continuation of solid economic news, solid earnings numbers now, and so forth. And I just wonder whether there might just be a bit of a pause here. That's just my sense, Pete. And I just, as you say, a lot's built into this. A lot of talk about deregulation, a lot of talk about cutting waste in the economy, cutting waste in government. I think the proof's a little bit in the eating here to some extent.
Okay. And I've long argued that eventually the really big tech companies in the US, the Magnificent Seven, as they called them, Apple, Amazon, Tesla, Meta, Alphabet, all of these companies have done brilliantly well, NVIDIA, of course, And I've always argued that they eventually either have to pull back a bit or just rise really slowly, and other companies will be the beneficiaries of lower interest rates or whatever. It seems like a bit of that's going on at the moment as well. The bigger companies aren't doing as well. But I still think America has upside because of lower interest rates and because of what Trump's promising. Do you see it that way?
Yeah, a little bit. I think they've had a pretty strong rally. I mean, I think we're going to need to see interest rates, that is the bond rates, come down. It's it hit 4.8% a couple of weeks ago. It's back down to 4.5. I think I'd like to see that head further south to give the market more confidence. I think there's some fear that with inflation is, I won't say tamed, it's been brought under control a little bit, but it hasn't been extinguished. And so the bond market's sort of a little bit worried about that. And I think that's the sort of the thing probably to look at most when you're looking at the US markets. Look at that, the 10-year government bond yield, what's happening to it. I think the market will basically fall in the line. So bond yields fall. I think the US market continues to go higher. And if bond yields start to rise up a little bit, I think the US market's probably due for a bit of a pullback. So my guess is probably, had a good month in January, bit of a rocky week last week. It's sort of a net zero week. I just think we might just have a little bit of caution, might take center frame for a little while at the moment.
Okay, let me bring up a stock that I think you could have a very serious conflict of interest with. And it's not Tyro, so I'm not going to mention Tyro, Paul. It's CBA.
Mm-hmm.
Now, you've been opposed to CBA's rapid rise, despite the fact I'm sure your latest holiday was paid by the gain in the share price of CBA. So how do you deal with the conflict that you probably hold far too many CBA stocks after being a former employee, but also you'd be surprised it's $1.166 today, some ridiculously high price. Where are we going with CBA?
Yeah, about 161. Look, hit a record high last Friday. I think it's off a fraction today. Look, I mean, I've sold a little bit, Pete. I've advised a lot of my clients and friends to sell a little bit, and they're all giving me a hard time about it. But I haven't sold that much, but I sold a little bit, and I'm going to continue to sell a bit. I mean, I just think it's. I think we're in the same situation we were a little bit towards the back half of last year, Pete. That the market is sort of getting this very positive lead out of the US, and all stock markets around the globe are close to record highs. So it's very hard for the Australian market to sort of say, hang on, we're not going to go up. But the problem for our market is that people are still very, with good reason, not comfortable about resource stocks. And when they're not comfortable about resource stocks, it means that some other part of the market's got to rise. And I think that's really been the issue behind why stocks like CBA just haven't been able to be sold off, because the market has to buy something, and they're not going to sell CBA because they think the market's going to rise. So I think we're still in that same sort of position. And a lot of the institutions sold a little bit of CBA early on. They've got quite burnt about it. They're now hanging on. Look, ultimately, it reports on Wednesday. It'll have to be, a pretty good report to keep the stock going up. But I think it's a stock that if you own CBA, I think it's you continue to lighten. And, looks like time's on your side. There's no hurry, but I think it's a stock that, you at some stage you will see at a lower price. So I haven't changed my view there, but
okay.
I haven't sold that much either.
Okay. Do you think next Tuesday we'll bring a rate cut? And if we do get a rate cut, that could be the start of something a little bit negative for CBA?
Look, it really probably wouldn't have too big an impact. It's a little bit revenue negative for them up front, but because they'll be under pressure to immediately cut all their home loan rates by 0.25%, and they'll probably have to keep the deposit rates, may not be able to edge down quite as much, or there'll be some deposit rates they don't get quite the margin back on. But there'll be governments watching, so the first cut will have to do pretty quickly. next, do we get one? I don't know. I mean, I think 80% of the market think we do. Interesting article by Warren Hogan arguing that we shouldn't have one. It's a new RBA board. Hard to assess, I think, of this one. I don't see quite the urgency. I mean, if you look at some of the corporate indicators, I mean, you look today at JB Hi-Fi's result, reporting sales of 7 or 8% growth year on year, and the January result was 7% higher than last January. So, sure, they're Australia's best retailer, but consumers are still spending, and the employment market's still pretty strong. I know everyone says they're doing it tough, and I'm sure a lot of people are. I'm not sure we've got inflation linked here either, but let's wait and see. I mean, I think you're on the school that they will cut next week. Is that right?
Yeah. Only because I think that you cut when you think the economy is going to keep on slowing, and I think the economy will keep on slowing for a variety of reasons. That last growth number was very poor, Paul. 0.8% for the year and 0.3% for the quarter. And remember, imagine if governments weren't building metros and roads and stuff like that. So I don't think the private sector is really doing all that well. And because we don't disaggregate GDP.
It's government spending that really where the growth has come from, right?
Yeah. And I'm thinking whoever wins the next election, the first year's budget's going to be a tough one because they always do that. There's been an excessive period of post-COVID spending. I think if Dutton wins, he'll go hard. And even if Chalmers is the new treasurer, is the existing treasurer, and he wins it again, I think they'll go pretty hard to try and rein the deficit in. And then we'll be in the hands of the private sector, and that's when I think rate cuts will be. But yeah, I agree with you. It's a close run thing. It's not an easy one to call at all.
I think each of the major banks' economists are calling for a rate cut. So the market believes there'll be a rate cut, and the market, in most cases, is right. So I guess you've got to back the market.
Yeah. Okay. One other thing I want to talk to you about is, you've had plenty of time doing nothing, enjoying yourself. Have you identified a couple of stocks that you think really look like good value for 2025? Paul, I'm sure you would have.
It's a funny one, Pete, because the stocks that look like good value, the market doesn't want to touch. And it's I've never seen the market quite as schizophrenic as it is at the moment. But look, here's a couple. I think for a growth stock, I like the Car Group. It reported today. Markets, it's just a little bit below consensus, but I think Car, which of course is the old carsales.com, is a really good business. It's now about 60% of its revenue is coming out of Australia, so it's really diversified. I think it's a really well-managed company, and it's got a great track record. So there's one for the growth takers. For the income seekers, I still like Telstra. Now, I know Telstra has sort of gone back into the unloved category. I think it's off a cent today. It was earlier, but it's yielding almost close to 5%. I look at that and say, well, okay, that's got about a 2 or 3% revenue growth. It's about the same as the CBA, but for some reason, Telstra's yielding 5%. No one wants to touch it, and CBA is now yielding about 3.25%. So I can't quite work that out why the institutions are infatuated by CBA. I love CBA when it was at $5.40. I loved it at $27. I loved it at $50. I loved it at $60. I loved it at 100p. I even loved it at 110.
Yeah, me too.
I just can't quite love it at 161. That's all. Yeah. But that's not to say that it can't go higher. It's just a really strange market.
And we also should make the point that if you're the number one stock in the ASX 200, people are buying exchange-traded funds. And when you buy exchange-traded funds, by definition, you have to buy CBA, don't you?
That's right. And of course, we've got a weighting of 10%. So every money that goes into an IOZ or VAS or any of the other, major index funds, of course, they have to buy CBA, and they do. And that's one of the reasons it keeps on providing buying support.
Yeah. It's certainly no longer the darling of the income chasers.
It's no longer the dollar. Have a look at the prospective dividend yield. It's about 3.25%. So it's not the
But of
stock
course, if
for
you
income.
chased it for dividends, you've got a fantastic growth dividend, that's for sure.
You sure have.
All right, mate. Thanks for joining us. Talk to you next
Thanks,
week. That's Paul Rickard of the Switzer Report. And that's the show for this week. Thanks for joining us. Don't forget, if you want to get more insights on how to invest, have a look at the Switzer Report. Go to switzerreport.com.au. Thanks for joining us. See you next Monday.